So now we're going to start with understanding of the financial statements which are required from a project manager perspective. That is a balance sheet, income statement, and statement of cash flow. First, let's begin with balance sheet, or commonly known as statement of financial position. So what does a balance sheet represent? The balance sheet, which is also called as statement of financial position, this represents the amount of assets, liabilities, equity, and their relationship at a specific time, mostly at the end of the year. So we can say that balance sheet is just representing the statement of financial position, the condition of the financial position of an entity on a particular point of time. One transaction and the entire balance sheet can change. So if you have ever noticed a balance sheet in your life, or I'll just suggest go ahead and see any balance sheet, it will always say balance sheet as on dash day. It always says as on a particular day. It never says for the period so and so. It never covers any amount of period. It just states balance sheet as on a particular day. So the balance sheet, it helps the users to assess the liquidity, the financial flexibility, the risk the company is carrying, and so on. By balance sheet, the companies get an idea how much amount is the company carrying by way of loans, how much has the owners invested in the entity, how much assets they are holding, how much their data is outstanding, how much cash, bank, liquid cash is there with them, and so on. The elements of balance sheet are assets, liabilities, and equity. And there's a golden rule is that there's a relationship defined between the various elements of balance sheet, which is assets will always be equal to your liabilities plus your equity. Basically, this means that all the assets are going to be financed by your liabilities and your equity. Equity is basically the owner's money, stockholders' equity. It comprises of various elements and all of that, but I just don't want you all to be bothered with the entire depth of financial statements because that's not relevant from a project manager perspective. But however, what's relevant will be caught for sure. So first of all, let's understand what is assets. The assets are the resources controlled by the entity or owned by the entity as a result of the past events. They represent the future probable economic benefits the assets are going to give to the entity. This was a bookish definition. To be honest, assets are those elements or those benefits which the company has accrued over the past by performing its past events, by performing the activities till now, whichever they perform, and gotten itself in the condition that they hold the assets now. Example will be the inventory. Entity purchased the inventory in the past and now it's controlling the inventory as of now. That's why it's there on their financial statements. A result of a past event, benefit for the future. The property, plant, and equipment, the investment, account receivables, everything is linked to performing some activity in the past because of which the ownership has passed the entity as of now. That's why they are coming in the asset side of the balance sheet. Similarly, liabilities, they are the present obligations of the entity arising from the past event. Their settlement is expected to result in an outflow of the economic benefit for the entity. Example includes the loans, bond issued by the company, accounts payable, vendors of the company. Company purchased the goods on credit in the past because of which it has to pay its vendors on a balance sheet date. Hence, they are a part of liabilities. Generally speaking, equity is the balance of the liabilities amount reduced from the asset. In other way, you can say the assets which are financed by way of liabilities, balance in that is equity. That is, they are financed by the owner's money, the equity of the company. Example of equity includes the common stock, preferred stock, retained earnings, and such things. Retained earnings is nothing but past undistributed profit. Remember this golden thing. Retained earnings or reserves and surplus basically means past undistributed profit. The company had generated profit in the past period, but they did not distribute to the owners. They did not put it to some other use, and that's why they are lying in reserves and surplus as of now. So, I hope with this you got a basic idea of what is an asset, liability, and equity. This is what comprises your balance sheet. Now, before we go ahead, I just want to take you into a depth of assets and liabilities. How are they classified first? Assets are classified as into two categories, current assets and non-current assets. Current asset is classified as a current asset or you can say a current item on the statement of financial position if it is expected to be realized in cash or sold or consumed by the entity within their operating cycle or 1 year, whichever is longer. So before we go ahead, let me just give you a quick description of an operating cycle. Operating cycle is a point of time when the company purchases it completes one operating cycle. Basically, from the point of time a company is purchasing its inventory to the point of time it's sold and cash is realized against that sale, that is one operating cycle for an entity. So suppose in case of a manufacturing unit, let me just put this way. Suppose if a computer chips manufacturer, they procured the inventory on 1st of Jan. They prepared the computer chip by 15th of Jan. The chips were sold on 20th of Jan and the cash was realized on 30th of January. So in this case, the operating cycle lasted for a period of 30 days, that is 1 month. From the point of procurement of the chips to the point of realization of that chip or the final product, that is one operating cycle. So now if you remember, I had said this thing over here, the asset is classified as a current item on the financial statement if it is expected to be realized in cash or sold or consumed within the entity's operating cycle or 1 year, whichever is longer. That is, if it is probable that the asset is going to be converted into a cash or benefit is going to be realized within the next 1 year or the operating cycle, whichever is longer, then it's an current asset. Now, if you have strike a question in your mind that at what point of time can the operating cycle be more than 1 year? How is it possible that company takes more than 1 year to develop the product and sell it? You're on the right track. You're getting a good hang of the financial statements now. But let me tell you this thing. There are certain exceptional industries where it takes more than 1 year of time to convert the asset to a finished product and sell it and realize the cash. The best example will be a construction industry. Imagine this thing, construction of a high-end tower, okay, a skyscraper, which is going to have a residential flats as well as commercial flats, commercial spaces and everything. But will that construction be complete within the 1 year? Will the construction commence on Jan 1st and guaranteedly complete on December 31st? In 99%, it's not going to be done, right? So there, the operating cycle is definitely going to be more than 1 year because the manufacturing or the preparation of the raw materials with the finished goods itself is going to take them for more than 1 year of time. And because of that, their operating cycles is going to be the higher of the 1 year side. It can be 3 years, 5 years, anything, till the point they're sure that this is a time by which we realize to expect collect the cash. So in those exceptional industries, the operating cycles do go for more than 1 year. Now the major categories or the major items which are included in the current assets are cash and cash equivalents because they are readily realizable in cash. They can be realized as in how you want to sell them. Certain individual trading items, that is the securities which are available for sale and they are held for trading part, like a company invested in the shares of a certain company just to play the price. It intends to sell it in the next 15 days itself. So it's going to be available for sale. The held for trading, the intention itself is to trade it on a regular basis. Inventories, the prepaid expenses, because they are paid in cash, but the benefit is expected to be realized in the next 1 year itself. Those are the kind of current assets. Non-current assets. Now these are those assets which do not qualify as a current asset first of all. So any item which is not qualified as a current asset comes in the category of non-current asset. Ideally, in a way, assets which are going to take more than 1 year or the operating cycle to be realized. Now, the major category in these non-current assets are investment and funds that are intended to be held by the entity for a period of more than 1 year or the operating cycle. So, investments in securities made to control or influence another entity and other non-current securities. So, whenever companies invest in other entities' securities, other entities' shares or investment in their bonds and when they issue debentures and so on, the intention is to hold them for at least a 5 to 10 years period till the time they're going to be realizing a good amount of returns. So those investments which are not going to be sold or realized in the next 1 year, they are going to be your long-term asset, basically non-current assets. Next is a property, plant and equipment. Now, property, plant and equipment, these are the tangible operating items that have been recorded at cost and they are reported at a net of accumulated depreciation basically. So suppose you have a machinery that has a life of 5 years. It's already running in the 3rd year. Do you think it's fair to report the value at which you purchase a machinery back before 3 years, supposing for $100,000, and the end of 5 years, the machinery value is going to be $0? So does it make sense to report the machinery value still at a value of $100,000 at the 3rd year end also? No, it doesn't, because you need to show the realistic cost the machine can realize if it's sold. That's why every year you take out a part of the machinery cost by way of depreciation, and that is called as the reduction of the asset basically. So in the 3rd year, the machinery will be recorded at just $40,000. That is $20,000 reduction for 3 years period. Remember this thing: every property, plant and equipment will be is subject to depreciation, except for one: land and natural resources. They are not subject to depreciation. They are subject to depletion. In case of land, mostly even that depletion is not allowed because land value is appreciating day by day. It never depreciates, to be honest. The land is the only scarce resource which is, even in the remotest corner of the world, it has an increasing value only.